Stocks really have been quiet the last couple of weeks, and we continue to see that today. Very extremely low volume, very extremely low trading range. It's August, and it's for at least in our household, it's the last week before teachers go to school, which would include my wife, and it's the last week before, the week after that, students will go to school. So it appears we're kind of in that mode of, the summer doldrums, the most summer of summer doldrums right now before school starts. We're seeing that reflected in just very, very little lack of participation in the broader markets as a whole. So we're going to talk about, this idea of how bullish we've been and whether or not that means we have to have, an intermediate decline now. And, do we really anticipate like this August, September, October period to lead to a big drop to the downside, the big spike in volatility? So we're going to break all that down in today's video. Very, very interesting Twitter thread that I wanted to talk about in regards to that. We're also going to break down weird market moves yesterday in terms of what sectors did well, how small caps, large caps did, and we kind of get back to normal today. And what does that tell us? So I'm going to break that down too in terms of what's driving the price action. And then we're going to talk about our trade idea, which is a stock that was kind of looking like it might be really bearish, like the market's coming out of that expiration here, this July expiration, but has since flattened out, like the rest of the market. So we're going to trade that. Let's go ahead and get started. Today is Wednesday, August the 4th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Nice little bounce in the short-term sentiment today, even if the S&P 500 was down 0.5%. Still, I mean, look at the range over the last 2 weeks. So we're not really going anywhere. So it doesn't really, like, yesterday wasn't that bullish of a day. The day before that wasn't that bearish of a day. This is the nature of the beast. So obviously we have a strong bullish posture and strong long-term market sentiment. So there's, they're both above 80. They're still strongly bullish. The near-term line has bounced out of bearish territory. That's a bullish bounce. When you don't stay down there for very long. There's a little bit of a dip, little deep of a dip, but the momentum line not getting to extreme lows. The near-term, combined with the overbought momentum line, and you got the near-term line oversold. It's not surprising we get a short-term bounce. The question is whether or not we'll get enough of a short-term bounce to get, like, say, the near-term line into the upper reversal zone, and we can still maintain some bullishness here. Like get another good near-term rally going. This obviously being a higher low point. I mean, this is a little bit of a near-term. If you look at all the previous near-term dips, this one, if anything, would look like that, right? Where you kind of had a mid-cycle expiration cycle, a mid-cycle dip to bring the near-term line down, but then we just maintain pretty much the same near-term rally, very similar to the last expiration cycle. So now here we started the expiration cycle with a dip, near-term dip, very similar to the last expiration cycle. It was the day before last time. It's the day after this time. But now, okay, are we rallying higher with this a little pause, and now we're getting another near-term rally like this? I think something like this is very likely actually for the next week or so going into August expiration, because we're just not, lacking a catalyst to spark any kind of pullback, but also considering how maturely bullish we are, it's hard to maintain strong parabolic moves to the upside, but it's also we're also not anywhere close to the 23% retracement level, which is where intermediate retracements begin, right? So retracement doesn't begin until you get to the 23% line. I saw a great tweet thread that said, just because we have been bullish for so long doesn't mean that we have to go down. And in the example was 2017. That was given, that we went so far, so long without a 5% decline. In fact, if you look at the zigzag ratio here, and I just did 5% moves. There we go, we got 5% moves. You can see in 2017, we didn't have a 5% move. In fact, the last 5% drop we had was mid-2016. So we went over a year and a half without a 5% drop, including the election there. And even with that election, it was, I believe it was pretty relatively close. Even that was over a year. A little bit of a difference here compared to that and compared to now is, we were only up 40. We were up 43% coming off of, a market sentiment low point. Really, that market sentiment decline started right there, and then we rallied over here. So almost a 2-year market sentiment run that ended with a 56% rally. It's a little different than now because now we have this move off of this low point. We're up about 97% off of that low. So, just a small difference in that regard. And we've had a few 5% drops since that market sentiment decline. We haven't had a 10% drop yet since that market sentiment decline, the last one. But also keep in mind too that the longer we went without one, the bigger the exhale ultimately was. Like on that big long intermediate rally that ended, the last intermediate rally that went parabolic, we ended up going down 62%. Ultimately went down 38% of the market sentiment rally off of that, off of the election low point. And if you look at, eventually later, after getting up to a new all-time high, we went back down into those same levels and then some, all the way down to the 62% retracement there, all the way down here of that market sentiment rally, right? Of that market sentiment rally right there. So like, yes, we can go a very, very long period without 5% moves, but then the problem with that is what comes afterwards. Like essentially what you're doing is you're pulling forward a lot of buying interest. You pull it, you pull forward all into one action. Again, doesn't mean you have to go down. We didn't have to go down there in November. Probably should have. We wouldn't have been so bearish there, but we didn't. Instead, we went parabolic, and we maintained strong for 3, 4, 5 months before finally selling. And you can see the selling went fast and hard within a couple of weeks. But within a couple of weeks, we had retraced. Just like I said, 1, 2, 3, 4, 5, 6, 7, 8, 9 days, we had retraced all of these gains all the way back to over here, right? All the way back to, so 1, 2 full expiration cycles plus a week, we retraced all of that in just 9 days. So I mean that's how fast sentiment can change. That was fueled by some tightening that was going on in China or overseas, as well as some trade related issues there. But it sparked a pretty long-term bout of volatility. We were still, all the way into October 2019, we were still pretty much at break-even levels with that January 18 high point. So over a year later, we are still pretty volatile before we finally made that bullish run, pre-COVID bullish intermediate rally. So yeah, I shared with you on Twitter there. This is one of the longest time frames. We're going into a seasonally weak time of year, that August, September, October, and it's not August. It's the weak one out of the 3 months. So keep that in mind, because the second most bullish period, 3-month period, is June, July, August. So August is part of the second most bullish 3-month period of the year, and it's also part of the most bearish 3-month period of the year. So take that for what it's worth. August isn't necessarily the one that will make or break any kind of move here. That's why I say we could still grind higher for another week or two. But if we do, the longer we go without having a normal up and down, inhale, exhale type move, then once we do exhale, as we saw in early 2018, it can be rather uncomfortable. Like, again, it's like you inhale, the markets inhale, they exhale. They inhale, they exhale. They should have exhaled right here. The NASDAQ did, but the S&P didn't. We came up again. We should have exhaled here, and we didn't. The NASDAQ did, but the S&P didn't. We started, the Russell's already exhaling right now, and the S&P is not. So, the longer we go without a normal exhale type move, again, doesn't mean we have to be bearish. Doesn't mean that we can't be bullish. We've been doing plenty of bullish trades. We've got a few trend trades going on in our class portfolio. So it doesn't, we don't have to, just because I say there's an opportunity, we're kind of like converging here, and we're not as bullish as we think we are. It doesn't mean that we live in this binary world of either I'm all bearish or I'm all bullish. Right? You can still have a mixture of both kinds of trades as we do, as we've done in our examples that we've done in these videos. But again, if you have this normal inhale exhale pattern and you don't exhale and instead you just continue to hold your breath, right? We continue to hold this inhale and as long as possible, then the exhale will just be deep. And again, it won't be like the 2018 was just a 38% retracement of the market sentiment rally, right? It was just a 38%. If you go back, there was nothing abnormal about that retracement move right there. I have to go back to the zigzag chart to see that. There was nothing abnormal. Oops, sorry. Zigzag here. Over here, there was nothing abnormal about that decline. It was a 62% decline of the intermediate run. It was a 38% decline of the market sentiment rally. Very normal. It was fast and it was hard, but it was because we had been so bullish for so long that once you let that deep breath out, then you get a 9-day decline that offsets multiple months worth of rallies. And it was very normal. And we stayed down for a couple expiration cycles because that's normal too. So, at some point, that wasn't bearish. We didn't fall off a cliff. It was the only reason why it looks like we fell off a cliff is because the rally that preceded it was so intense. And, that's what we have right now. We have an intense rally. We're up almost 100% in a short amount of time coming off of that big low. And again, any kind of pullback we get that may appear to be intense, it won't be because, if we fall down 38% of the market sentiment decline, will just be around that 78% rally of this intermediate run, this 9-month-long intermediate run. That's it. It's just typical retracement. It's just atypical in terms of size because the rally is very atypical, and that doesn't get talked about very much. But atypical rallies lead to atypical declines. I don't buy into this 5% pullback, 10%. It doesn't matter. 5 or 10% doesn't matter. It's the 23%. It's the 38%. That's what matters because it's the size of the rally that produces the size of the pullbacks that we get that come afterwards. So let's take a look at some of these other charts. You can see we talked about before. The PPO is still very high on the long-term chart here. So still very, very strong extreme momentum. We haven't started to converge at all. A little bit we have. If you take a look at the long-term view on this chart, and we go back, say, 5 years on a weekly chart, you can see we are diverging. You can see that MACD is coming down. The moving average is also coming down. The MACD is below its moving average. We peaked over here the first week in May, and even though we've been above the 8-week exponential moving average and going higher, we are converging, right? So that can definitely be a process of convergence, but that's the idea. That's what's going on here. If you take a look at the Bollinger Bands, with the same idea in mind, we had this big pop in the Bollinger Bands, and you can see the band width is still relatively high, but it's still converging. Like these two lines are moving in towards each other, even if we're still easily in the upper quartile of the weekly bandwidth. You can also see too from a directional movement index, again on the longer time frame. So let's go out to a weekly chart. Again, we've had a good strong bullish run that peaked right there, and this one peaked in February, and you can see we had that last peak there in April, first week in May, and then since then you notice we've been converging. The highs have been getting lower, the ADX is dropping, the lows are getting relatively higher. So we're still pointed higher, we're just in convergence mode. And finally look at the RSI and the CCI, and you can see on the daily chart we're converging as these are trending lower. But of course, if you look at the weekly chart, we've peaked. We peaked over here in the first week in May, and we've been converging. We peaked on the CCI. In fact, we've got a divergence on both of the RSI and the CCI. There's still a very, very bullish territory, so we're not going to fall off a cliff anytime soon. As you can see that in that 2017 period, the reaction went so parabolic. That was another reason why we fell so far so fast in that 2-week time frame. We're just converging right now, and that's the nature of how these kind of markets move. So don't anticipate like that to next week we're going to have this big decline. We might, there we went parabolic. We're not going parabolic now. So we're going to be in a convergence mode for a little bit of time, and that might mean we just grind up and down to the upside without any significant downs until we finally do get that exhale, at which point we will make that 38% retracement on a market sentiment basis, and that will be uncomfortable for a lot of people that are trying to catch up off that COVID low point with a lot of really aggressive bullish trades now. And you see that the chart I always look at to kind of get a reflection of risk appetite and how bullish risk appetite is Bitcoin. Bitcoin, I believe, is a reflection of speculative trading and how bullish or not speculative trading is. And you can see it had a little bit of a run up to this 40,000, and we're just kind of stalling now. It's not surprising that you stall. You are well up above the 8-day moving average when you made that spike, but now we're stalling and we're converging. So is the MACD peaking and we're coming down? That obviously remain at the negative MACD for so long. That remains to be seen whether or not we'll continue higher or not and get up through the Fibonacci retracement zone. See, we're in this retracement zone now. We never did get out of it. We had the nice bullish rally off of that October. This is the same intermediate run that we had in the S&P 500. It peaked in April expiration. It came down. The S&P didn't, but this came down all the way down to 62% retracement. So it started that retracement when it broke the 23% retracement line right over here in May 13th. That's when it started its pullback. It pulled back down to the bottom of this retracement zone. Now we're still in that 38 to 62% area. It's stuck. It's not bullish. It's not bearish. It's stuck until you get back above 52,000, which is probably unlikely, or get back below these lows, 30,000, which would point us at least towards 22. And again, would be a reflection of overall risk appetite in the market as a whole, in all markets as a whole. Again, speculative risk appetite, not just regular risk as in terms of buying a stock, but speculative risk, like risk as in buying, I want to buy something that will make me a lot of money really fast. That type of speculative trade that a lot of these retail investors have been looking for with these meme stocks and things like that here lately. Here's the daily chart for IWM. SPY, we gapped down. We filled in most of the gap in the morning, pretty much all of it. There's a little bit left, but then we came back down. I think we're up a little bit in the after hours right now. Again, very tight range over the last couple of weeks. It's until we break out, we're really tight. The brown lines are last week's range, and we're still inside of last week's range with 2 days left to go. So that's something to keep an eye on. That's not the case in IWM. We are in last week's range, but we're not at the top. We are right around the midpoint, and there is not very much volume down here below. So, an important level to watch tomorrow and Friday for IWM is yesterday's low point. So this 217. Break 217, it's going to be very easy for it to go down. Last time it went down overnight, and it recovered it really quickly because that's very, very light volume overnight. We'll see if that ends up being the case again here. From today's range, volatility or volume and range, 2.39 points, 46 million shares trading. These are August numbers. These are very, very typical of summer. Not very much of a move. 2 points way off the charts down here. 40 some odd million, 46 I believe, way off the charts down here. So, and we're already, the ATR already, the average, which is the 14-day average, is already extremely low as it is. So to get today's number at 2 is really, really light. Very small range. And volatility you can see is extremely low. Sitting it's at 18. That's not extremely low. We're not below 15. But we're not, we're just closer to 80% than we are 90. So that's a very extreme level for VIX relative to VIX 3M. If you take a look at the range we have here, that historical volatility has been slowly moving up. Not very much, but this gradually, since the middle of June, we've been getting some bigger moves. We started off with that decline, then we bounced up sharply. We had a couple of, 1% drop there, bounced up off of that. So other than that, some bigger results than what we were getting previously that brought the historical volatility to such extreme lows. So we are, still relatively low. When you compare us to the 52-week range, the highest point was over here last September during the intermediate pullback. We're nowhere near that point, but we're also not off those lows. So when you look at that with the slow trend higher in the VIX, right? So this is the that slow trend higher that we've been getting going into this bullish area. It's just something to keep an eye on. Heading into September and October are the worst months for the S&P from that monthly standpoint. Though August, like I said, is part of the second most bullish period with equities in June, July, and August, but also part of the worst period. So it's kind of a make or break type month. But won't be the big down month that maybe some people are anticipating itself. It will more likely can kind of set us up for that type of move going into September and October. So getting us more into a grinding mode, setting us up for the big breakout. So if you, again, looking at the DMI for SPY, we are down to getting to extreme lows. This typically precedes, when it's down this far, some kind of directional move, one way or the other. And the last big directional move we had with the ADX relatively low in the last year was that bullish move. And we had another little bullish directional move there. And you see they're getting smaller and they don't last as long. And now the ADX is back down again, ready for another directional move. Will it be, if it's another bullish one, the pattern doesn't look like it's going to be very big. If it's a bearish one, then that's what we're going to be kind of keeping our eyes out for, to see if that is that deep exhale after such an extreme inhale. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today, and number two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our videos. Of course, if you don't like them, you don't have to click on anything. But if you do like our videos and you want to let us know, hit that thumbs up icon. You can do it right now while you're watching. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. We give our free subscribers a unique offer to check us out, so see what that is by clicking on that link. Follow me on Twitter for more content in between the videos from day to day. There's my Twitter handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things over here on the right. Again, every day I do the Market Outlook. I do a Market Outlook live video at 3:30 Eastern Time on our website. You can find it here by clicking on this image, or you can come up here and click Live Trade Review. I review all the trades that we've done previously, just make sure we still stay in them or not, if we need to close out any. I also put on today's Market Outlook trade already today before the market close, so that's where you can see that here. All of our paid subscribers get access to that video. Obviously, our premium subscribers get access to pay less per month to do that. In addition to getting other, things, the premium subscribers get access to our forums as well as our premium tools and resources. They also, again, all of our paid subscribers get access to our trading rooms, except for these two Q&A sessions. Brandon's tomorrow, mine on Saturdays are also available only for our premium subscribers. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Hit this thumbs up icon, opens up another new tab. Hit that like button there as well. Again, the more likes we get, the more engagements we get, the more people will see our content because that's how Twitter and Facebook work. It also benefits you because Twitter and Facebook will promote content in your timelines, especially Facebook, from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, so yesterday we saw a really interesting pattern here. I tweeted about it last night right here. Yesterday we had energy and discretion, or excuse me, and industrials and financials and materials all led the way higher. Those sectors recently have been more associated with small cap stocks. and less so with like say XLK, XLY, XLC. Those have been more associated with QQQ. So when you look at this chart right here, you think, okay, well, IWM must have really significantly outperformed QQQ because of how these responded. But if you look at the actual IWM and QQQ, it wasn't the case. In fact, the Qs doubled the returns for IWM yesterday. So very interesting development there, and that actually continued today. When you looked at how the different asset classes and how they performed today, you can see the Qs. I mean, look at that. Over the last 3 months, there have been 2 assets that are up 9% or more, and they are the Qs and long-term bonds. And then you have another one up 7%, and that's real estate, commodities falling off. And then down at the bottom, you have emerging markets and small cap stocks, both down relatively significantly, especially relative to SPY in the last 3 months. So that's the last 3 months. Let's take a look at just now today. And you can see, okay, remember after yesterday's kind of weird results, IWM was down significantly again, down 1.25% by the end of the day, down closing at the lows. Commodities down significantly too, but emerging markets were higher along with QQQ and long-term bonds, and the dollar for that matter. That was an interesting development. The dollar, again, is another reflection of risk appetite, being a risk aversion trade, and you can see the dollar rolled over, hitting that resistance at that 62% retracement level, and rolling back down towards this area, this 117.5. So pretty significant bearish move. Very bearish short-term sentiment, rolling the intermediate line back down. Again, that's not necessarily the most risk-on trade. When we look at bonds, they were down from the open, but they well off of their lows and were up 0.25%. So we still maintain the strong bullish posture in bonds. Gold, of course, with the strength in the dollar, well off of its highs. It gapped up and came down. But again, that's not surprising when you consider just how bullish the dollar was. That's going to have a weak effect on gold. But that doesn't necessarily mean gold has to underperform. Again, going back to the asset class comparison chart for, again, just today alone, gold might outperform certain equity asset classes. In fact, it outperformed SPY, it outperformed the small cap stocks, it outperformed developed markets. It only didn't outperform the Qs, which right now are kind of its own safety asset class perspective. So, and again, the biggest move to the downside today, the biggest outlier move is commodity prices. And commodity prices, that's a couple of days in a row now, a pretty significant bearishness. Now, again, we're still above 60. We're not out of bullish territory. We're definitely not threatening to be bearish anytime soon. We are well below the 8-day moving average, however, and in fact, after opening up below the 17 but finishing above the 17 yesterday, we have just now closed below the 17 and the 30 at the same time today. So that suggests that we might get a leg lower in terms of some bearish momentum. You can see it's been bullish for so long. The MACD's been above zero for so long. Brief little pause right there, but it's been above zero. But we've been consolidating since that peak in May, in the middle of May. Well, now, again, we'll see if this turns up into something, a little bit more bearish than what we've seen before. If you take a look at the directional movement index for commodities, the positive indicator hasn't really fallen below 20 yet. We've already done it once post earnings expiration. The negative index isn't nearly as high as it was that same day. So, we're not necessarily we're definitely not threatening the 23% retracement level. But it is something to keep an eye on as we as it figures out the sideways action that it has. It has this big point of control that if it breaks down, then you can see there's not a lot of support below where when we get down into the now lower half of the bandwidth and flirt with the lower quartile again of the bandwidth. So, very important that we either bounce right back above that 17-day moving average, or we might see that commodities are telling us something in terms of risk appetite. Remember, the other thing to watch is Bitcoin is a reflection of big speculative trades, and we made that big burst higher, but now we're back into the middle, unable to get through the value area yet. If we can get through, great, but if it doesn't get through, then it's again a sign that there's not as much risk appetite out there, especially on the very speculative end of the spectrum, risk appetite spectrum, as we may think there is. Let's take a look at the sector moves. So, again, a very, very weird move yesterday, right? Well, let's compare it to what happened today. You had all those kind of reopening sectors, materials, industrials, financials, energy. Well, they were the big losers today. Energy down almost 3%, industrials down more than 1.33%, along with staples. Materials down 1%, along with discretionary, and financials down almost more than 0.75%. So they all really came down with small cap stocks. So that makes a lot more sense. And then you can see Q's held up because XLC and XLK outperformed. So now we're kind of back to normal, and you can see the safe haven nature of these. Even with real utility started off really bearish, but they rallied and closed at their highs of the day, even kind of filling in some of the gap that they had. We have real estate here, well off. Real estate started the day strong and finished down, but off of its lows. You can see about the time utilities rallied, so did real estate. So a little bit of a move, measured move into safety into the afternoon when everything started to kind of fall. Small caps fell to their lows, and the S&P started to work its way down around the middle, right around the European close. All right, well, that takes us to our trade idea of the day. Boeing is what I was looking at today. Boeing's had an interesting pattern here. We've been bearish, but we were really extreme with these clusters, and we've come out of the bearish territory, and we're stuck in the middle. Now, we're not really bullish, not really bearish. We're about as neutral as you can be from that perspective, with the momentum line, the intermediate line, the market sentiment line, all right there, right around 50. The near-term line is barely out of the neutral zone, just barely above 60. But very, very neutral pattern after being relatively bearish when we had, like I said, 3 clusters in a row there on the chart. As you can see, that move also produced a pretty significant directional move initially, but then we have since gone non-directional and brought the ADX, instead of lagging behind and eventually catching up like it usually does, instead we went non-directional. It's all the way back down below 20, just like that. If you take a look at other indicators, you can see the RSI and the CCI went back into neutral territory there. You take a look at the directional or the trend strength indicators here. We are still below the cloud. We're flirting with the blue and the green lines there. We have a relative, we're not nearly as bearish as we were. We were in strong bearish territory, almost at -5 at 80. It's hard to get to -5. It tends to be pretty extreme, but now we're to the point where we are another day away. In fact, at the highs of the day today, this trend quality was at 0. So the trend noise balance was to 0. So that's how close we are to losing the bearish trend that we have. We're only by coming back down to the lows of the day today, we still maintain those the strong trends down there. If you look at the Bollinger Bandwidth, it's been falling. You can't really see it very well because that throws off the scale back there. But if you just kind of zoom in, you can see, okay, we had a pretty wide bandwidth over here, relatively high, and we've been falling. And looks like we're right at the middle of the bandwidth. Like we're here at an important volume node. Lots of volume in this area, in the value area. We tried to get below the value area. We came right back into it, and now we're holding it for a support level. And you can see the big strong volume you have up above us, and again the support we have down below us right now. So that sets me up for doing an iron condor spread. Like I said, we already did this in the Market Outlook live video today before the market closed, but we're going to sell the 20 deltas, mid 20 delta here, sell the 210 by the 205. We'll come over here, sell the similar delta at the 26. 245, 250. That gives me this particular iron condor spread. Full position size because we are through earnings now. And then I've got these break evens, these slices here. You'll notice I like where they're at. We've got this range between the peak on June 24th right there, and then those 3 clusters in a row, low point on July 19th. we've got this pretty volatile range that we are smack dab in the middle with that we can trade in between without earnings into September expiration, with a lot of volume in this area to kind of hold us in this area. In fact, I believe this will come off the the next month, few weeks. This won't be the point of control anymore, and it will be over here, and then we'll have the shift in the value area, which is this is the peak, there's the bottom. It will shift to be right around this. So I believe that we'll trade right around this tremendous volume node for the next 6 weeks or so, as we head into that September expiry. At least that's the basis of the trade, why we're doing this particular trade, based on what we're seeing on the charts. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.